Hello, how are you? Today I will cover the Starbucks stocks. The ticker name is SUBX, and this is one of the requests by one of our YouTuber who put the comment there, or the investor, I'll say. Seems like the person is pretty young age and doesn't have the money. It's as per the comment, invest, but it doesn't matter, right? Whether you have you can, because a good return, if you have a good company and the solid foundation, it can be achieved. So in my channel, I will cover, try to find the intrinsic value of this stock using, as you can see on the, using the net profit model, enterprise value model, and the free cash flow model. Then we'll weight it and to come up with the final stock price. Then we'll also look into the overall, like the top returns, some of the liquidity and operating margins quickly, to see how the company is behaving, and some of the risk which I like to see. I like to tell you based on the coronavirus impact, how the company quarterly statement affected, and what's company view at end of the years for its financial projections. So a lot of good information is coming. So please stay tuned with me, and hope in this exciting new journey. Okay. So myself, I'm a Pramod Kumar. I'm a CFA charter holder and FRM certified. And in my channel, I value stocks and provide the opinion from on the stocks from the long-term perspective. Okay, so without any delay, let's get started. Okay, so this is the net profit model. As you can see, I have taken the 10-year worth of data from September 2010 to September 2019. This is the annual based data. The revenue and the net profit. This is the year-over-year net profit growth, and this is the 10 years annual based revenue growth, which, as you can see, this is almost 10%, but in the last 5 years the revenue growth is dropped. The same pattern I have noticed in the net profit margin. If I compare with the past, if I take the 10-year annual growth, it's 14%, but it's not even half for the net profit margin. So it seems like the company is not doing well in terms of generating the revenue, or in terms of increasing the bottom line. So that's why, to be of more conservative side, although we have a 10-year worth of data, I have taken the averages for 5 year and the 5-year growth rate, just to be a little bit more conservative. So as you can see, my net profit growth rate is 5.47, and then I take the long-term growth rate to 2%. My required return, I expect the single stock at least to be giving me 10%. If it's not giving me 10%, then I don't like to invest. I just rather invest in S&P 500 ETF, which historically average can give me 10 to 12% return easily. Okay, the current the PE right now for the stock is 25, which is basically, it's telling you that 25 if times of its earning, people are trying to willing to pay for this stock. And this is a little bit short on the industrial average, and this industrial average I have taken over the 10 billion market cap company. Based on that, I have come to this industrial average. If you can even just see from the industrial average comparison, the stock is cheaper, right? Because it's lower. And if you don't know how to compute the PE or understand that, you can search on my channel. There is a video to how to take the industrial average, and also how to use the do the current PE. So you can find that information as well. So then I'll use the discount model. Basically then, okay, one more important point, the growth rate, rather than simply taking the growth rate for a long period, I use the interpolation and decrease the growth rate. As you can see, it was 5.47 and then 5.09 and so on, and for until 10 year I decline it to 2%, and that's how the cash flow is growing. So basically each year I am growing the cash flow by this growth rate, and the PV is nothing but the discounted cash flow using the 10% method. If I do like simple math, then I'll got the market cap. My internal the value of the market cap in the present terms is $72 billion, because this is in millions. At the moment there is 1.17 billion shares in the market. So if I simply do the math, what is our price? So this model, which is the profit, if I take from the income statement point of view and take from the 5-year average perspective, I got $62. is my value coming. Okay, so we have from one model is giving 62. Let's see what other two models are giving, and then we'll take the average. So from enterprise value model perspective, EV model, again I have taken the 10-year of data. So this is the enterprise value I have calculated, because this is too much data to show, and to avoid the I'm not showing the computation here, but this is the overall. So basically, if you want to go and buy the company in September 2010, it's take 101 billion dollars, and now today is taking at 273 billion dollars. So similarly, we have this operating income plus depreciation, which is called EBITDA, and this is the data shown here. So this is 6.2 billion, 7.2 billion, and so on. So if you can see, I have, rather than going here, we can easily see here the 10% growth annually on the enterprise value, which is way good. And from the enterprise value perspective, the 5-year growth is also consistent, right? Which is a little bit increase actually, if you can see 10.90. And the operating income is way decreased, as you can see, from 12% to only little shy of 5%, right? The debt is consistent, basically it's 35.16% year-over-year increase. So seems like the company is taking a huge amount of debt. So if I take the debt, which is 549 to 11 billion dollars, right? So it's a huge debt. So if I take the ratio of operating income to debt is 1.79 times, where it was not even 0.23 when the start of year. So it's a big growth in terms of debt. So it seems like the company is increasing the debt to grow their enterprise value. Okay, so again, I take a little bit more conservative, so take only the 4.94% as the EBITDA growth rate. So in this EBITDA, I'll take the average EBITDA, which is 5.89 billion, and grow at the rate of 4.96. And again, this one also I have decreased to using the interpolation to 2%. It's similar approach, and then grow the EBITDA by this growth rate. Using the again same 10% acquired rate, and which giving me forecasted enterprise value of $181 billion. Here I have reduced the average debt and average cash in this formula, which I'm not showing here. So basically like this, you can easily see. Now, if I divide it by the number of share outstanding with the second method, now my value is $155. So which can be seen. So this is from the second method. So now we have two numbers. Let's say what's from the free cash flow method. So once we have using the free cash flow, so free cash flow basically saying once you pay up everything, so everybody, what's your free cash flow left, right? So that's your free cash flow. So, or the simple terms is operating cash flow reduce the capex. I use a simple method to compute the free cash flow. Do the simple math, and then you get the free cash flow. So here the free cash flow grows at the rate of 10% for the CAGR, and the 5-year is 5.79%. So again, we have seen the consistent drop in terms of all three models, in terms of either the free cash flow growth, net income, or revenue, or the operating margin, right? So it's consistently half. We have seen all this. So that's one of the reason I have taken the 5-year rather than 10 years, just to be conservative. So here my average free cash flow growth, I took it, although and then increase it by this growth rate, and then discounted by the 10% as a simple math. So here it is giving me the market cap in value of $56 billion. So this is how it is coming. Here the terminal value I have taken, it's 12 times. So I am assuming that after 10 years, we can sell this business 10 times of his free cash flow. Actually 11.58 times of the free cash flow, which is, I can even take 15, but the way I am seeing the growth is slow and all, although it's a global brand, is better. I just take that using some math. Okay, so if I use a third method, I'm getting the $48.37. So now we have three methods, right? So if I take all these three methods, which is the enterprise profit model, it gives me $62, enterprise value model giving me this number, and free cash flow model giving me around $50. I do some weightage, almost equal weightage on three models, and then my price is coming as $88.11. So if I go to the market today and see the price, oops, I think I have made the mistake here. So the price is around $77 today. So let me just write it down. So yeah, so that's what we have seen. So right now, if you see, the share price is even below its average, basically our intrinsic value. So the price, so which we assume the price at the 10% required rate of return. So for sure, the company is giving a little more over 10%. So that's from the intrinsic value, but do wait a little bit. Don't skip the video, because we also need to see how the coronavirus and affect the company, right? How it's affecting, because the company is close, how the economic behavior is close, and also need to check on the liquidity side, which is very important. Right? So I have 3 more slides to go, and to make it so we can see this from all the angles and make a very practical and complete decisions, or maybe the rational decisions. So from the top level return perspective, if you can see, we have this percentage and then return on investment, equity, and assets. So when I compute this from the 10 years perspective, so this is in 2018, there is a return on equity over 386. So that's why it's very spike, but don't get rational. Overall, if you can see here, maybe I increase this, the return on investment is over 20% consistently, right? And in 19 it's is even better, so that's good. The return on assets is also in 2-digit. So overall, the returns, the top level returns, either investment capital, equity, and return on assets, is doing good, except one case which is maybe exceptional. On the operating the profit and EBIT margin perspective, this is the profit in oranges, which is going closer to the 35% range, and the income, the profit margin, which is going over 10% range, which we can see here. So let's quickly check the liquidity, and then we wrap up after seeing some risk of this stock. So from the liquidity ratio, the 3 important ratio we know: the current ratio, the quick ratio, and the cash ratio. So these are the current ratio is the overall ratio. Basically, it's the current asset divided by the current liability. So basically, the cash is pretty much, we're looking more into the cash on the numerators, or the liquidity, like market security. So these are more like a strict, once we go more down here, right, from blue to orange to gray. If you're not sure how to compute this, I have also a channel, not only on the liquidity ratio, but also on the profit margin, and all on how to compute the in my channel. So you can search that as well. So if you can see, anything above 1 is considered very good. So far is good, but in 2019 you can see all 3 ratio dropped below 1. So current ratio is closer to 0.1, which is 0.92, but the quick and the cash is even lower. So it's closer to 1 if you see the overall, the current ratio. So it's not that bad, but and in the historical, we see the company is the cash and more liquid, like a quick ratio, is pretty much on the 50% ballpark range, right, which we can see from here. And if you like so far my video, I suggest kindly please give a thumbs up, and if you new to the channel, do subscribe. I really appreciate that. And if you have any new stocks to cover, please put in the comment, just like this YouTuber. Sorry, and so we can see that. So this is the latest Q3 earning as published on the Starbucks website. So I just quickly glance over it because we already know the price. We just want to see how the company is doing during the coronavirus time. So this is as the latest as the quarter. This is the 3 quarter ended because the Q3 statement, and then this is only this quarter ended. If I can see that it's very clearly seeing, we can see the top level, the net revenue, which is coming from, most of the revenues coming from the company operated stores, right? It's 5.5 billion for only this quarter, and so it's way reduced, right? It's 3.4 billion only, as compared to, look at the 3 quarter ended in. So if we see the first 3 quarter is 13.99 billion, where it's like a $3 billion dollar loss as compared to the last year, right? 2019, right? Hopefully you can see this well. And if I see on the bottom line, so because of that, the earning, there is a loss rather than have a profit, right? So the quarterly, it was 1.13, but this quarter it is a 60 cents loss. And if my assumption is, if let's say what the company or the management think from the last slide, that from the coronavirus impact and how they see the year-end future for this company. So this is from their the quarterly statement 10Q, and what they have mentioned that our financial condition and results for the fiscal 2020 have been and are expected to continue to be adversely affected by the recent coronavirus outbreak, right? So here they are saying the reduce or volatility in demands for our product, right? So the demand is product, because there are store closure, are there modified operation business model, reduced customer traffic because of illness and all, right? Which is disruptions to our operation or operation of business partner, including license and joint venture. So it seems like it's pretty bad. Impact to our business partner, our ability to operate and manage increase there. So their operation cost and supply chain management cost increases. Customer footprint are reduced, which is very bad, right? And they don't know. And there is a huge volatility indirectly, and the reduction basically in layman term, they're saying in the demand for the product. Why somebody want to spend like a $4 or $5 in a latte, right? When the company doesn't, and the most of the people don't know. They are unemployed and all, right? So need to count these. Increased volatility and significant disruptions of the global market, right? Due to the coronavirus impact, right? So overall, I think the company is not doing well, and if the market behave like that, the company won't be doing well. Okay, so that's pretty much. So we know the company is right now is below its value. So as you can see, the models, 3 models which we have calculated, is giving the price, so we can get this share cheaper. But my understanding is, if the second wave come, maybe there is another problems to it. So if somebody is, and especially on this food and this industry, right? So the company is good, and I love the Starbucks products, and the quality and the environment and the ambience it's one of it itself, right? But from the maybe the share price won't go, but I think the share from the fundamental perspective, the value, the company has a value, but from the other perspective, the coronavirus perspective, so it's depend. If somebody can take a little bit risk, they can go and buy, or if somebody can think they can wait a little bit, it might be better. So there is also one super investor. His name is, if I'm not mistaken, let me check who invested in this stock. So his name is, I was just confirming, the Bill Ackman. So he invested heavily on this. So this is it's under his one top 10 list on his portfolio. So this stock has the backing of some of the big super investor. So, but what do you think? I think Yeah, so let me know, put in the comments, and please kindly subscribe and like this video, and comment if you want me to review any other stocks just like this, YouTubers. Thank you for suggesting these stocks. I really appreciate your time spending to view this video, and thank you for your time, honestly. Bye for now.